The U.S. housing market has been a frequent topic in the news, but a crucial factor is being ignored when determining the direction of home prices. This factor is the current months of supply of homes for sale. In this video, we'll delve into the intriguing connection between supply and demand in the housing market and how it affects home prices nationwide. We'll also accurately assess what to expect from home prices for the remainder of 2023. From the bustling cities to the quiet suburbs, we'll examine the current state of the U.S. housing market and provide insights into what it means for buyers, sellers, and investors alike. Due to memories of the housing bubble and the Great Recession, many people anticipate a decline in home prices. As a result, I conducted a thorough analysis of the leading markets in the United States to demonstrate the flaws in many reports that attempt to predict the direction of home prices. It's important to note that I'm not referring to the usual fluctuations in home prices, but rather a sustained changing trend over an extended period, and not just a few months. In general, home prices will only experience a decline lasting a year or more if the balance between the supply and demand shifts towards an excess of inventory. This can happen in a few ways. Demand may decrease to the point where the existing supply exceeds market needs. Supply may increase far beyond demand, or both supply and demand may shift in a way that results in an oversupply of homes. When there is an excessive number of homes for sale, the market is driven by buyers, resulting in a decline in home prices. In the opposite scenario, when there is a limited number of homes for sale, like we're experiencing now, the market is driven by sellers. While various factors may influence the housing market, the supply and demand dynamic is the only factor that has a lasting impact on home prices in each local market. There are no other significant influences. You might say, but what about the economy? To which I would reply, changes in the economy impact the demand for homes. And you might point out changes in the mortgage interest rates. And again, I would demonstrate that mortgage rates impact demand. You could mention supply chain disruptions, and I would show how those impacted the supply of homes for sale. So, regardless of the issue, we look to supply and demand to determine the direction of home prices. So, let's take a look at 4 different graphs that best illustrate where home prices are heading, one of which you will not find anywhere else but here. We'll examine what the latest numbers reveal about the current supply and demand dynamic in 992 metropolitan areas tracked by the Zillow data machine. The latest reports from Zillow and other reporting agencies show that year-over-year home prices fell for the first time in 10 years. This fact has led to an amateur speculation of home prices dropping by 30%, 40%, and even as much as 50%. And you must wonder, are home prices going to crash? This graph illustrates Zillow's U.S. median home price measurement from 2008 until now. At the far right end of the graph, it can be observed that the median home price in the U.S. dropped by $100, which is equivalent to 99.97% of the previous year's median price by the start of February. The graph's 2 most recent stars indicate that the gains made in the median home price throughout 2022 have been nullified due to an equivalent decline in 2023. I am placed the blue stars on the graph to show that the median home price tends to decline at the start of every year, typically through February, and then rises from that point forward. While many reports call for continued price declines, history tells us we should expect the median to rise. Of course, who needs expectations when we can measure the supply and demand for homes? Our next graph is unique to our channel, has information nobody is talking about, and you won't be able to find it elsewhere. If you're a longtime subscriber, then you know I often discuss home prices because most real estate reports rely on hype to get views, often avoiding the truth if it becomes too boring. If you're not a subscriber, please click the thumbs up like button and subscribe now so that you get all my new content when it is fresh. If you really want to know what's going on in housing, to see and hear the data explained, to evaluate the facts and ignore the hype porn that is so prevalent online, then subscribe now and I'll keep you in the know. After acquiring Zillow's latest data on housing inventory and monthly sales, I discovered that out of 992 markets that Zillow tracks, I could compare the balance between supply and demand in 94 of the metropolitan areas. The resulting graph isn't pretty, but it sure speaks volumes. This graph plots the months of supply of homes for sale in 94 key metropolitan areas tracked by Zillow. Overall, it shows that the average months of supply of homes for sale across the U.S. is 4.2 months of supply, a level that historically would be considered a seller's market. But if you have seen my recent video on how digital has impacted home sales, then you know that I believe housing market equilibrium has changed. In order to keep today's video brief, I will encourage our viewers to check out Market Equilibrium, how the balance has changed in real estate, for a thorough analysis of why we should measure market equilibrium at 4 months of supply rather than the historical 6 months of supply. This graph shows market equilibrium, the relationship between supply and demand that produces historically normal rates of growth ranging from 4 to 6 months. Any result above the yellow field is in a strong buyer's market. Any result below the yellow field is in a strong seller's market, while those within the yellow field are near equilibrium. Current measurements indicate that just 7 markets out of 94 are in clear buyer's market conditions, while 60 markets, nearly 2/3, remain in seller's market conditions, and roughly a quarter of the markets are in equilibrium. Does this look like a U.S. market poised for home price declines? Look at all those colored lines falling below the yellow field. Those are markets that are expecting home prices to rise. The ones below the yellow field can expect unhealthy, very high appreciation rates. Only the 7 markets above the yellow area are anticipating prices coming down. So how in the world are people hyping a 30%, 40%, and even a 50% decline in home prices? These reporters are either ignorant or they're lying, neither of which is a trait worthy of your attention. Despite home prices being resistant to a substantial correction, this does not imply that the housing market in the United States is in good condition. In fact, I believe it may be in its worst state ever. This graph compares the median home price with the median family income over time. The median home price is plotted in gray, while the median family income is shown in blue. The resulting ratio of home prices to income is shown in gray. For at least 50 years prior to 2000, the median home price fluctuated between 2.5 and 3.5 times the median family income. From 2000 to 2016, this ratio grew to 3.5 to 4.5 times income and recently has shot above 5 times income. Families today spend twice as much on housing as they did 50 years ago, and the reason is clear. The U.S. does not have enough homes to house its growing population. To conduct a thorough analysis of the housing market, it's important to recognize that there is only one market. There isn't a distinct market for single-family detached homes because buyers have the option to choose a condominium or townhouse instead. Similarly, there isn't a separate rental market because tenants can become buyers and vice versa. Also, there's no new home market because buyers can choose between new and used homes. To evaluate the potential of the housing market, it's necessary to examine all parties involved, including buyers, tenants, sellers, home builders, and landlords. One cannot argue that there is a shortage of homes if a record-level number of apartment building units are currently under construction. We must study the trends in rental rates and home prices to find the supply and demand dynamic that most likely exposes a market change. The signal is loud and clear when prices and rents move in the same direction, higher or lower. When they are moving in opposite directions, the signal is clear too. The graph displays 2 variables, the median monthly rental rate and the year-over-year change in rents. The blue area represents the median monthly rental rate, while the red line indicates the year-over-year change in rents. Currently, the year-over-year change in rents is more than 6% growth since this time last year. Both home prices and rental rates have soared higher in recent years, a signal that there is not enough shelter in the U.S. Some local markets are not facing these conditions, but the U.S. is short on housing overall. With prices flat or falling and rents rising, it suggests there's something impacting home affordability. Reflecting on the housing bubble and the Great Recession, it's intriguing that rental rates didn't decrease despite the fall in home prices. As inventory moved from the for sale market to the for rent market, rental rates continued to rise. This observation is significant because it suggests that the cause of the housing crisis was not overbuilding, meaning that we did not produce too much shelter. Instead, it was a shift in government's traditional lending standards that limited demand from home buyers. The government's actions did not impact the need for shelter, but made it challenging for people to secure home loans, leading them to consider renting properties instead. As the inventory of for sale properties grew, many builders and homeowners moved from the for sale market to the for rent market. Despite millions of new rental properties being added to the rolls, rental rates rose, a clear sign that we had not overbuilt America. Unfortunately, most builders and developers could not afford to build homes and have them sit, so they quit producing more homes. The evidence is clear. The demand for homes has fallen, but so has the supply of homes for sale. When we look at the data that Zillow has collected on the existing inventory of homes for sale, coupled with recent home sales, it is clear that the months of supply of homes is such that we should expect home prices to rise at historically normal rates, 3.5% to 4.5%. Fewer than 10% of the market should expect to see home prices fall, while roughly 1/2 of all markets should experience home price appreciation above the historical norm. The U.S. housing market is experiencing a significant shortage of available homes for sale in most local markets. This lack of supply is expected to result in a continued rise in home prices throughout 2023. While this may seem daunting for potential home buyers, it also presents an opportunity for current homeowners to maximize the value of their investment. As the housing market continues to evolve, it's essential to stay informed and to adapt to changing conditions to make the best decisions for your financial future. Whether you're looking to buy or sell, avoiding hype and understanding the trends and factors that impact the U.S. housing market is crucial for success. Is your home on the market and getting very little attention from buyers? Or worse, did you list your home for sale and after a full term on the market, is it still unsold? If you're a frustrated home seller, I've got the perfect video for you to see. It's called Your Home Failed to Sell, Now What? And you can get the answers you need by clicking on the box in the top left corner of your screen.